AIG is a company that offers services ranging from life insurance to travel insurance all over the world. They work not only with individuals but with large firms as well. This case study greatly emphasizes the importance of financial contagion with today's global businesses. Financial contagion is when a financial crisis in one country affects companies in a different, unaffected country. Due to many companies being connected internationally, financial contagion creates a domino effect of collapsing global financial institutions. The mortgage bundles that AIG was selling were faulty in the sense that they were at a high risk of being defaulted on, but their investors were not aware and purchased them anyways. AIG Financial Products, abbreviated as AIG FP, is one of AIG's subsidiaries and the main reason of AIG's financial collapse in 2008. AIG FP started handing out CDOs, which are collateralized debt obligations. CDOs obtain value due to a collection of fixed income assets that are considered either safe or risky. AIG FP didn't realize the consequences of these CDOs because they were too wrapped up in the too big to fail ideal. Another aspect where AIG gained revenue was from selling credit default swaps. This turned out to be another hit against AIG's investors since most of these CDSs were not paid back to their investors, causing investors to lose large amounts of money and increasing AIG's ever increasing liabilities. AIG's financial collapse affected many financial institutions worldwide and is a prime example of financial contagion of businesses. AIG's financial crisis affected investors and banks in Germany, France, and England. There were different reasons why financial institutions were susceptible to AIG's collapse. AIG's $60 billion payoff to European banks caused controversy due to the fact that they only used $44 billion to pay off American firms who were equally affected. AIG also attempted to renegotiate the loans it had with its American creditors, giving the impression that American creditors were less important than their European counterparts. When AIG chose to use a majority of their bailout money on European countries, many Americans were upset with both the government and AIG. During the time the government gave AIG the bailout, many American homeowners were struggling to pay their own debt. American tax dollars were being used on a large scale to help bail out IG. Questions arising after the bailout. Should the government provide companies with bailouts? Is it fair for the government to provide some companies with bailouts and not others? The globalization of finance has led to both advantages and disadvantages. Globalization has allowed wealthy companies to be able to expand their businesses into developing countries. The expansion of these global companies into developing countries has helped these countries grow their economies and infrastructures. Disadvantages of the globalization of finance are financial contagion and currency risk. Currency risk is a potential harm that arises from changes in the price of one currency relative to another. In order to leave behind being associated with the financial crisis and their faulty business decisions, AIG repaid the money they were given by the government in order to improve their public perception and rebranded their logo to start fresh. After the 2008 financial struggle, the U.S. created the Dodd-Frank Financial Reform Package. This package was made with the goals to eliminate bailouts and eliminate the too big to fail ideal. The reform also hopes to improve the financial system's solidity in order to protect businesses from financial contagion.